Hi, welcome to another episode of Talking Tax with Alex. This is part 2 of our closely held insurance company series, and in this episode, we're going to cover what the series is about. So I'm just going to introduce the court case that we're going to look at. We're going to look at the series overview, so just what each video is going to cover. In this video, we'll take a look at the basics of the tax years at issue and the structure of the taxpayer. And then we're going to look at the facts of just the insurance setup, the regular insurance that the taxpayer had versus their closely held insurance company. And we'll wrap it up with some closing thoughts. So in this episode, we're going to cover Reserve Mechanical Corp. And so I have two court cases listed here, and you can see that the first one is TC Memo 2018-86, and the second is AFTR 2D 2022-1804. So the only things that matter in this is, or there's a couple of things that matter in why there's two court cases, is this is the same taxpayer, but the first case, the TC Memo 2018, was a tax court case that was resolved in 2018. And then the second case was the appeals case that was resolved in 2022. And the years matter because we'll take a look at the next slide in a second, but 2018 was when the first case was resolved, 2022 was the second. We've already looked at, or in the first episode of this series, we looked at the basic org structure and terminology, and I'm going to link a video, or I'm going to link to that video, and I'll put a link in the description, but we're not going to cover that here. Instead, we're going to begin our court case analysis, and we're going to just look at the insurance facts and background of the court case. We're going to continue in part 3 of our court case analysis, and we're going to look at the taxpayer facts and background. And then we're going to conclude part 4 with a court case analysis, and we're just going to look at the court's ruling. So look at the tax years at issue and the deficiencies. So remember, we were talking the tax court case originally resolved in 2018, and the appeals case resolved in 2022. So the tax years at issue for 2008, 2009, 2010, like these are over 12 years old. It took almost 12 years for the IRS to audit and resolve this issue, go to court, and have it resolved. And if we look at the deficiency, it's really only, it's only about $500,000 or so, and for some court cases where there's millions of dollars at stake, this is not necessarily a big sum. Why is this court case so important? It's because it's so recent, and there's two layers to it. So it went to tax court, and it went to appeals court. So there's a lot of authority, and this case is going to help outline what the IRS is going to use when examining closely held insurance companies. So let's take a look at the taxpayer structure, their closely held insurance company structure. So there's two gentlemen by the name of, last names of Zumbaum and Weichel. They owned a mining company called Peak Mechanical and Components Inc. In 2008, they decided to open up their own captive or closely held insurance company called Reserve Mechanical Corp. It's reinsured by Pool Re, so I put that in here because it's a small issue we'll talk about later, but basically reinsured means it's a backstop for insurance companies that get insured by other insurance companies, so that just in case they have to pay out claims that are above their liquidity and they might go bankrupt, they get insured themselves, so that they're no longer, it's basically so that they have protection against going bankrupt from paying out too many claims. And so in this basic structure, the operating company was paying about $400,000 for insurance coverage, and I put question mark because that's really the issue at hand here for us in this case. Like, was this really insurance coverage? We're going to take a look, and we're going to really examine it. So that's really the point of this episode. In episode 2 is, we want to really know, was this insurance coverage really insurance? So captive, and I put a little star here to point out that captive insurance companies or closely held insurance companies are created for the purpose of writing coverages that are generally unavailable or impractical to obtain in the conventional insurance marketplace. This is important to remember for later, but I just wanted to point it out now that the whole point of creating an insurance company is so that you can get insurance that you normally couldn't buy on the market. So let's take a look at what Peak had for insurance that they did buy on the market. So just a very standard, it looks, or very standard, and this kind of gives us a baseline for how they operated before. So they had insurance provided by EMC Insurance Group Incorporated, just a random, regular marketplace insurer. And 2006, 2007, and for the first half of 2008, you can see their insurance premiums here listed. 2006 they paid like just shy of 40,000, then about 95,000, and then it looked like in the first 6 months. So maybe if they had a full run in 2008, they'd probably be paying like 110,000 or so of insurance premiums, and they got coverage for anywhere of 5,000 to $2 million of whatever policy. And their interaction with claims is pretty basic. They before 2008 they had some auto insurance claims that they filed, but in 2008 they had some snow damage to their roof, and insurance paid $2,000 to them, and they paid out of pocket $25,000 to replace the roof. So they tried to argue with their insurance, and the whole point of looking at their commercial insurance is to get a baseline for how insurance really operates, because we're going to look at how the captive insurance operates in a second. But just look, commercial insurance, the insurance company's just saying, no, we're only paying $2,000, and they fought it and they didn't win, so they had to pay out of pocket. Like there's a tense relationship there. The insurance company doesn't necessarily want to pay out your premiums or don't want to pay out the coverage if they don't feel like it's covered, right? So let's go look at Peak's captive insurance coverage. So their 2008 policy, which is very important and very sketchy if you look at this, is they had 13 direct written policies that were effective for 1 month. They paid premiums of $412,000. So remember, their last year, 2008, for the first 6 months was $57,000. So annualize that for a whole year is like $100,000. So they're already and they kept their commercial insurance previously or throughout the rest of the years. So they're paying an additional $412,000 for $13 million of coverage. So six of these policies were retroactive to 2005. So again, that's very wild. And then all of these policies had extended reporting periods, 3 to 4 years. So it does, like, a real insurance company is not going to open themselves up to liabilities from, like, they're not going to give you a 1 month policy that then opens them up to 4 years ago and 3 to 4 years in the future. Like, no insurance company is really going to do that, right? 2009 and 2010 policies are very, very similar to the 2008, except they cover a full year, so at least they have that going for them. But the 2009 policy dropped 3 policies from 2008, which really brings into question how valid were those 3 policies for that 1 month period. I mean, how valid is that 1 month period to begin with? I mean, that's another question. But then we look at the next following year, and you drop 3 of them, so you have to really question, did you need those in the first place? And just a quote from the court case itself, but each policy contained an other insurance clause which provided the limits and deductibles stated herein only apply after coverage is exhausted from any and all other valid insurance policies issued by any other insurer. So basically, the closely held insurance policies had this like other clause in there where it wouldn't kick in until every other insurance was exhausted. I don't know enough about insurance to know whether this is regular, but the fact that there's a bunch of irregularities in the previous policies already makes this one stand out, where there's just another clause that makes this insurance seem very, very not regular. Not regular. So let's look at Peak's captive insurance issues. So I took this quote from the court itself, but singular carelessness, which is what it noted how the policies were written. So 2 of the policies had the incorrect company as the insured. The directors and officers policy did not list a single insured person. 3 policies in 2008 were dropped a month later, which is what we just talked about. And commercial insurance was available to 6 of the issued policies. Six of the 13 policies you could get commercial insurance for. And remember, when we first looked at the structure, the whole point of closely held insurance company is so that you get insurance that's not readily available on the market. More problems was in the pricing of the insurance. So there's inconsistent pricing. There's no insurance data used for pricing. They used pricing based on sales revenue. And again, I don't know much about insurance, but I know that you need to have actuaries and you need to actually do a risk analysis of the business to come up with pricing. So, the closely held insurance company, the way that they formulated their pricing, those premiums of 400,000 had almost no bearing in reality. And even worse, they didn't even compare to commercially available policies. So not only were there policies that were available on 6 of the 13, they didn't even look at the price of those to see if they could buy them, on the commercial market or not. And it gets worse. So claim handling. So remember we looked at how the original basic insurance, commercial insurance that Peak used, and they had, the regular auto insurance, and then they had that one claim for the roof where the insurance company pushed back and settled with them for only $2,000. That's how a real insurance interaction would happen with the business. So here, the Peak put one claim for $164,000 between 2008 and 2010. So there's only one claim ever used on this insurance on all 13 policies, and it's really bad because the reserve, so the closely held insurance company, they never investigated the claim. There was no evidence submitted for the claim. It wasn't even examined if it was covered. The claim was covered. And once this insurance claim was paid and settled, it was supposed to be done. But 4 months later, they paid another sum of almost the same amount on a settled claim. So can you imagine an insurance company actually doing that, where they say, all right, we agree, well, let's ignore all the other stuff. Like, let's ignore that the insurance company doesn't investigate or doesn't have any evidence or even know if it's covered. And can you imagine an insurance company paying on a settled claim again? Like, that's unreal. So a quick quote that was taken from the court case itself is, another feature of the pool re-coverage, so remember that pool re-coverage is the reinsurance, it's a stopgap coverage, is that however made the above limitations are more theoretical than real. The limitations were unlikely to ever come into play because pool re would incur a liability only if what the policy called an attachment point were satisfied. So what are those limitations? So the reinsurance policy, the backstop, so limitations, the reinsurance is supposed to stop the insurance company from going bankrupt if it had to pay out too many claims. But there's so many limitations on pool re's reinsurance of Reserve Mechanical Corp that it was seemed unreal, and the court picked up on that based on the last quote. There was a $450,000 threshold for it to kick in. It was limited to 15% of the premiums paid, so it was only limited to $672,000 on $8 million of coverage, and the entire payout was limited to $8 million of the entire 50 captive pool. So what that means is, if everybody in the pool filed a claim and exhausted this, that catastrophic backstop that's supposed to stop the insurance company from going bankrupt, there would be no money. There'd be no money to kick in to stop it. So it really doesn't seem like there was any backstop here to diversify risk. The credit co-insurance arrangement with Credit Re. So Credit Re is another company, and I'm not really going to go into it because I'm just going to quote the court because this one didn't really feel like it had any legs. The court said there's nothing in the record showing what liability Mechanical Reserve was allegedly insuring, so there's no evidence, nor was there any evidence of how the premiums for the credit co-insurance agreements were calculated. So again, I'm not really going to cover what is going on with Credit Re. The court basically said the evidence is garbage, and we're not going to give this any merit. So that's the end of episode 2, where we just look at the insurance coverage of the court case, and hopefully you're starting to see where this is going and why this case matters so much for closely held insurance companies. It gives us a really good background and a kind of a backdrop for what works and what doesn't. Now we have a really bright line on what a good closely held insurance company would look like and what a bad closely held insurance company would look like. But wait, there's more. I already said there's going to be parts 3 and 4 after this, because this is only covering insurance issues. Next, we're going to look at the taxpayer and the shareholders and their issues. There's a whole nother section of issues. So if you thought the insurance coverage was kind of goofy and sketchy, let's just take a look at the taxpayers and how they set this all up. So that's the end of this episode. If you enjoy this content, please like the video, subscribe to my channel, and leave comments or email me your thoughts. Thank you. Bye-bye.